cycle, which is quite precise. And so what have we gotten? Quantitative easing to fill the gap. Well, quantitative easing has created the biggest financial asset bubble. You look at stocks today and think we were in the greatest economy getting ready to get way greater. And what we've really had is an unrecovery. You know, we've been growing at 1.65% since the 2009 bottom, with massive stimulus, with very low inflation. We should have high inflation and high growth with this much stimulus. And it's because they're fighting a declining tide. And the cost of this, not allowing recession, not allowing the bubbles and the debt to shake down like we normally do, we've got a monster financial asset bubble. Daniela, the most important number in the world right now is $520 trillion. That is, by the way, 6.2 times 84 trillion GDP in financial assets, stocks, real estate, bonds, that sort of stuff. Normally that would be 2 times GDP, maybe 2.5 in a normal boom.
Yeah.
Debts at 253 trillion. That's off the charts, over 3 times global GDP. But normally that'd be 1.5. You know, so they use this financial asset bubble to offset the debt deleveraging and the debt bubble bursting, and now we have a bigger monster. And I am predicting within weeks or months, the central bank's just going to lose control over it. It's just going to burst. If you notice, and this is the reason for my prediction here, that we're going to see a 40% plus crash in just the next few months. Every correction since the January 2018 top, that was when the real bubble started to top. And then we get all this seesaw backing up. We get a crash, we get a new high, and then every time we've got a crash to new lows, which means the market is trying to go down. We've peaked. And the next new low would project 2,100 on the S&P 500. That would be 45% from the recent top. That would mean the tech stocks would go down even more, maybe 50%. So I think the next crash, what people finally see is the central banks keep pumping up the economy against these downtrends, creating this monster bubble that keeps wanting to burst and deleverage along with the debt, and it's a losing battle. And when people say, well, yeah, don't print another, I'm sorry, don't bother to print another 10 trillion this time. This thing's over. This thing, they lose control. And that's just going to be the first crash, and we'll end up by late 2022 or early 2023 back down, 80 to 90% to basically erase this entire crazy bubble. One clear cycle stands out like a sore thumb. 90-year super bubbles, 1839 to 42 crash, 1929 to 32 crash, and now 2020, 21 into 22 or 23 crash. This is a constant rhythm, and that is meeting a 40-year cycle, which I've been preaching. I've said in the early 80s, we'll have the greatest boom in history, and we'll see the lowest point in stocks in late 2022. 1942 generation bottom, 1982 in stocks, Bob Hope generation bottom, and now baby boom bottom in late 2022. So we got the greatest up cycle colliding with the greatest down cycle 2.5 years later. And I do see the biggest crash of our lifetime. I've been saying this for years and years, in the boom and when we started to bust in 2008 and afterwards. And we never finished the process. We could have had this bust. 2008 and 9 could have gone into 2010, and we could have had that 29-32 shakeout, deleveraging, and bigger crash. No, they turned on the fire hoses, didn't want to deleverage debt. The price of not deleveraging debt is to create the biggest asset bubble in history, which is going to burst harder and faster than that debt bubble would have. They've created a bigger monster, and it's harder to control. You have to ask yourself, what takes longer, to deleverage debt with Chapter 7 and Chapter 11 reorganizations, which takes months or years, or just to have markets crash suddenly like they did in February, March last year? That was 40% global in stocks, 5 weeks. That's how fast a financial asset bubble can deleverage. So these Federal Reserve people who've never had sex around a business have done a grand experiment that is going to backfire on them. And I do not think you'll have a basis for a Federal Reserve or central banks after this crash. People will say, oh, all they did was create the biggest bubble and crash. And oh, you know what? You go back to when they were created, 1913 for the first time. 20 years later, roaring 20s bubble, 1932 crash, 33 bottom and depression, 25% unemployment. This is what central banks do. Pump, 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 make things look good today, create bubbles, overextend, and then crash. They've done it again, bigger time. No, they're just trying to fight the real Bitcoin and blockchain revolution. They're going to be a big crash first, because this is a big first stage bubble like the dot-coms on a 20-year lag. I've got this in my February newsletter, just perfect correlation. You can see Bitcoin is going just like the dot-com. Big bubble on high valuations on an early stage, which is way overvalued. Big crash, a lot of them go under, and then the real revolution comes, and you got the internet being the biggest boom in history into recently. So that's the same thing going on here. Blockchain can restructure monetary systems with a potential Bitcoin gold-like standard at some point when Bitcoin gets high enough and stable enough, where you could have a bottoms-up system that grows totally by transactions of consumers and businesses and governments, and is no longer top-down micromanaged by central banks and politicians who always overstimulate, always push down their currencies to cheat for exports. All governments do is manipulate in the wrong way. We got to get rid of this. The best safe haven, you can go to cash and preserve while everything goes down. That's good. What is great is to buy a 30-year, the longest duration, safe treasury bond. That will be the safe haven, because their rates will go from 1.8, be pushed down to near zero. That'll cause that bond to appreciate 40% or more when everything else drops. Normal corporate bonds will drop some. Junk bonds will drop more like stocks. There will be you're right, there will be very little places to hide. Cash flow assets, solid cash flow assets, and the highest quality bonds, and that would mean only AAA corporate bonds. I'd still rather have the 30-year treasury, because gold is an inflation hedge. This is going to be like 2008 started to be before they turned on the fire hoses to combat it. And that's why we haven't had inflation. They're combating deflation, which always comes after bubbles, okay? So it's going to be a deflationary process, and gold edged up into the 2008 recession, the early stages. And when they saw Lehman Brothers goes up and saw the deflationary breakdown, gold went down 33% in like 2 months, and silver 50%. So gold will not go down as much as some commodities, but gold is not going to be the safe haven in a deflationary environment. And Bitcoin is not either. Bitcoin is not a safe haven, nor is it an inflation hedge. And the institutional money in Wall Street is buying Bitcoin as an inflation hedge instead of gold. It's not gold. It could be gold in 15 years. It's not gold. It's not an inflation hedge. It's not a safe haven. It is the biggest bubble, which means it will ultimately burst the biggest along with stock. Now, gold went up, Daniela, and then in 2012, it went right back down, because even with all the money printing, inflation was still going down at some point, and gold finally realized, oh my gosh, and the gold bugs have been wrong about this. You don't get money, you don't get inflation in a deflation era. All you do is curb deflation. You're not. I tell people in speeches, and I say this seriously, there is no way in hell you can create high inflation, nevertheless hyperinflation, in this winter season deflationary environment with so much debt and bubbles, always pushing to deleverage, which is always, always, always deflationary. 9 out of 10 financial crises in developed countries have been deflationary, not inflationary. So I have to argue with the damn gold bugs too. I was introduced at a gold conference as the contrarian's contrarian. They think they're contrary. I am contrary to them. We both see a crisis, but I see deflation. That changes the investments that do well.